Again, his introduction is in page number 5 and 6. Started as a practicing chartered accountant. Recently, I helped him to surrender his COP because it was a last date. Due dates were there for him to get into this. I don't know what is that. Advocate? No, it is an application. Bar Association. So I helped him to surrender his COP. I helped many to get their COP, but few of them are here who I helped them to surrender their COP. Now he is practicing as an advocate. Of course, academically also, if you can just go through his biodata, he has secured a rank in CS Inter, and of course he has done well in all his academics, and also he is doing well in his practice. With these few lines of introduction, I welcome Narendra. He will be taking us through this case studies on transfer pricing, which all of you have discussed in the groups. I request Pooja, what's your name? Yeah. To welcome the speaker with So now it's over to Narendra.
Respected seniors in profession and dear friends, good evening everyone. I start up with thanking Uta Srinivas, SIRC and ICI to give me this opportunity to present case studies on the transfer pricing. I thank the group leaders. They already, I believe, taken you through the case studies and gave a lot of answers, so it reduces my burden to that extent, or at least created some amount of confusion so that I can capitalize on that. Mr. Prasad ended with a deeming fiction, and I am starting with a deeming fiction. In fact, my fiction here in 92CE is multiple fiction. It's a fiction on fiction, supposition on supposition. And if you can say it is many more time a fiction. Transfer pricing itself is a fiction. You're really transacting at 100. Say for example, it's a sale transaction. The tax officer today makes it say 120. That itself is a fiction. There's no real income in that 20. Then that 20, today by virtue of this provision, we create a fiction that it is advance. So that's a second fiction. On that advance, we again create a fiction that will calculate interest. So it's a third fiction. So it's just the extension of multiple level of fictions, and fictions are always interesting. So is this provision.
How about compound interest on that also?
That still there is no provision. We hope they bring in that provision. Like one of the groups were discussing, there's an interest on perpetuity. I would say this provision is anything perpetuity for professions. Because I don't know how much tax the government will really collect out of this particular provision. But surely we will have an entity for our life. Let us start. Has already discussed the facts, so I'll just quickly move to the issues. As we know this provision, why it is brought in, the intention is to try to get the funds which are lying with the AE by virtue of an ALP computation. Just a micro level example, you have done at a sale of 100 rupees and the ALP is 120, the idea is to get back that 20 rupees. Originally when the provision came, the presumption at least I had that they really want to tax or collect tax. But if you go through the sections, they really don't want to collect tax, they just want to get that money into India. So we don't know how successful they would be. There are two parallel themes that run in the section. They are like railway tracks which don't just cross anywhere. There's a one parallel theme of a secondary adjustment and second parallel theme of interest calculation. If you you go carefully through the section as well as the rule, they ask us to do secondary adjustment and they ask us to do interest calculation, but there is no real connection between both of them. If you look at the secondary adjustment, it is not a new concept that India has invented. It is there in many countries, but they have implemented it in a different way. So, for example, we have constructive dividend concept, that whatever money is left with the associated enterprise, it is treated as dividend. In the Indian context, if it was treated as dividend, for example, the Indian company would have ended up paying dividend distribution tax, one-time dividend distribution tax. Some countries treat it as constructive equity contribution or adjustment to the capital already contributed. So there is an adjustment which is made to the capital value of investment, which may not have an immediate tax effect, but only have a tax effect when the ultimate sale is made. The third concept which we have adopted, that is the money which lies with the associated enterprise, we are trying to say it is a loan and it becomes a constructive loan on which the notional interest is computed. The Parliament in its wisdom thought that the third approach is much better. We do not know what were the deliberations, why first or second approach has not been accepted. To my knowledge, all the countries have adopted the first approach. Countries which had adopted third approach, like South Africa, ultimately moved to the first approach of deemed dividend, which was much simpler for execution. You collect one-time tax and the matter gets closed. But possibly they thought of employment generation for professionals. Just look at the flip side, whether India would permit this kind of a remittance out of India. If I had an associated enterprise, say in Sri Lanka, they Control-C, Control-V provisions from our act and paste it into their act, then will India tomorrow permit remittance outside India? Will our FEMA provisions permit it? Possibly no. There is no provision which will permit us to remit it. Assuming even the Indian tax officer says that the actual sale price is more, suppose I have done a sale at 110 and he himself computes the arm's length price at 105 and accepts my transaction to be at arm's length. Therefore, 5 rupees is an excess received that amount I have received, which the officer is also accepting. Will he permit me to remit it? Possibly no. In fact, we specifically have a provision currently, 92C3 and 92.3, which very clearly says that transfer pricing is a one-way traffic, like most of roads in India, roads in Bangalore at least. That means it is only a revenue favoring adjustment. You do not make an adjustment to the assessee if it, by virtue of a transfer pricing, if it results in reduction of income or increase of losses. So based on the book entries, if I have calculated the book profits, and if ALP is actually lesser than that, that means it is resulting in reduction of income, that is anyway not permissible under 92.3. That means we are today acknowledging the fact that India will not permit an outward remittance of a secondary adjustment similar to that what we intend to do by virtue of 92CE. Third, if India were to hypothetically permit it, will I get a deduction under 37 for that? Can I say it is a deductible expenditure or it becomes a reduction of income? Possibly again no one is going to give me a deduction for that. So when I do not, and when Indian policymakers would not possibly permit a reverse kind of a scenario, expecting any other country to permit a remittance to India would be again and only a theoretical situation where really that would not happen at a practical, in a practical situation. But that may as it is. We need to look at the provision as they are. We need to analyze them and look at their implication in the actual situation what we would be having today. What is the provision? So, the groups have discussed this aspect, but there are certain interesting points that emerge out of this. 92CE and Rule 10CB, and there is a proposed amendment to Rule 10CB. Then, as I said, India has adopted a process where we want to say that it is a constructive loan. We need to understand two particular concepts before we move further. Primary adjustment. So primary adjustment, as we understand, it's an adjustment to transfer price. That's the transaction value which I am actually entering into an international transaction. By determination of transfer price in accordance with the arm's length principle, which results in increase of total income and reduction of loss. So again here very clear that the primary adjustment what we are talking under 92CE is only a revenue favoring adjustment. That is, it would trigger only when there is an increase in total income by virtue of ALP computation or reduction in losses. The other way around is clearly excluded from the definition of primary adjustment. The most important part possibly is the definition of secondary adjustment. And this becomes important because the section 92CE1 very clearly say that assessee will make a secondary adjustment. So that means I need to identify and I myself need to make a secondary adjustment. So what is the definition of secondary adjustment? Secondary adjustment means an adjustment. They have used the word means an adjustment in the books of account of the assessee and books of account of its associated enterprise. So this is the first limb of it. So you make an adjustment to the books of account of the assessee and to the associated enterprise. Then it says that to reflect the actual allocation of profits between the assessee and its AE are consistent with the transfer price determined as a result of primary adjustment, thereby removing the imbalance between the cash account and actual profit of the assessee. So what they are trying to convey that where there is a difference between the transfer price or the actual transaction value and ALP determined. So you will make an adjustment in the books of assessee and associated enterprise to bring the books of account to the actual ALP transaction. So if I recorded a sales at 100 rupees and ALP is determined at 120 rupees, they want us to make an entry for that additional 20 rupees and bring it to the level of 120 rupees. That is what the section says. Now, there are a lot of issues that will arise as we go further, we will see. But one preliminary is, can the Indian law mandate you to pass an entry or make an adjustment in the books of associated enterprise? To that extent, that word in the associated enterprise is clearly extraterritorial. The Indian laws can only have effect or to the subjects of the under 251 of article. It can have only subject effect to the causes and effects related to the territory of India. We cannot go beyond that. Now what happens in the associated enterprise, country of associated enterprise, is completely lookout of that particular country. It may have its own regulatory framework where you cannot pass this entry. It may have its own regulatory framework where the remittance may not be permitted. So there could be a lot of such things on which the Indian assessee will naturally have no objection, no control, and will have actually no control over those. So to the extent of adjustment in the books of account, possibly by adjustment in the books of account, they are trying to say that assessee will pass an entry, in our example 20 rupees in his books of account. How that would be done, what would be the implication as we go further, we will see. Now this entry should try and reduce the imbalance between the cash account and the actual profit of the assessee. Again, what they are trying to say here is, it's not very clear what you mean by cash account. Possibly it is the debtor account which can really happen. If you pass an entry debiting the AE, that is the effect of that I need to receive 20 rupees from the AE. So to that extent, only the debit can be passed to the debtor's account. Now whether that can be done, not done, as we go further we will see. But that is a intention which is coming in the law, that you will pass an adjustment in the books of account. What would be implication of passing an adjustment in the books of account? That itself will be an issue. Then there are 5 circumstances which are given. These 5 circumstances are necessary in terms of the secondary adjustment to trigger. Secondary adjustment will apply only to international transaction. It will not apply to specified domestic transaction. There is no provision for that. We are only looking at the international transaction. 5 specific circumstances. If I fall in any of these 5, this section will be triggered. If I can demonstrate that I am not falling in any of these 5, naturally this section would not be applicable. What are these 5 circumstances? Suo motu primary adjustment in the return of income. So assessing himself by filing return of income, that return of income could be a return under 139, it could be a return under any of the provisions of 139, possibly it could be a return under 148, it could be a return under 153 capital A, it could be a return under 142(1). It doesn't say return filed under 139. So if I make a suo motu adjustment, even a return filed in response to section 148, possibly the secondary adjustment will trigger. To that extent, this is the first clause. Second clause is where the main challenge lies, and most of the cases are where will fall in the second clause. The second clause says that addition is made, assessing officer makes a primary adjustment and it is accepted by taxpayer. So AO makes an adjustment. This is first phrase we need to understand. Second phrase we need to understand what do you mean by accepted by assessee. When do you say assessee has accepted the primary adjustment? So if I say that, if I demonstrate that the adjustment is not made by the assessing officer, or if I am able to demonstrate that I have not accepted the adjustment, then I should be able to move out of section 92CE, and I would be able to argue that 92CE is not applicable. Generally, there are various stages of assessment. Now, the challenge would arise at what stage you would say you have accepted. The addition may be assessing officer. We have an example which I have given where the addition is enhanced by the CIT appeals. Addition might be made by DRP, for which they are famous, at least in Bangalore. Then, I would have filed an appeal to the tribunal and it might have dismissed my appeal. I could have gone to High Court, it might have dismissed my appeal. I would have possibly gone to Supreme Court, it might have dismissed my appeal. There is nothing beyond that. We cannot go to International Court of Justice. So otherwise, given a choice, possibly SSC would have gone there. So once, suppose the Supreme Court passes an order, do you say it is accepted by SSC? Is SSC accepting it voluntarily or it is the forced acceptance? So can I say then this section is not applicable? So if that is the case, every case at least we will go to Supreme Court and therefore increase the work for professionals. So this acceptance by the SSC is something which we need to deliberate further. Possibly as we go further we will deliberate. That is one very interesting aspect that we need to address. We will come to this particular point because other points are more simpler. So we just look at those and proceed further. Third point is the APA. When you are doing an ALP is determined in accordance with ALP. In that context, it becomes that you recompute the ALP in accordance with the APA, then the secondary adjustment to trigger. We need to see the implication for rollback years, 4 years rollback, what would happen the years which are forward years. So that means after filing the APA, how would really compute the for the rollback years. The procedure for APA has prescribed in 92CC, 92CD is that once the APA is signed, the SSC will file a modified return within the time prescribed under section. That modified return will again be looked at by the transfer pricing officer at whether the modified return is in accordance with the APA. He will pass an order saying that it is in accordance with the APA and close the assessment. So if you look at that way, when you are going to the APA, possibly that adjustment which happens at least for the rollback years in accordance with the APA may fall in various clauses because it's also coming in the return of income. There is also an order passed by the assessing officer, no doubt accepting assessor's computation. But given that APA, there is a specific limb or some specific clauses in 92CE. It should not fall in clause 1 which deals with the return of income. So if I file and make an addition now by virtue of an APA in the modified return, the assessee, the particular case should still fall in the APA and not in the return of income. The reason is the time limits trigger of 90 days are different. When it is a return of income, the time limit is linked to 139. When it is APA, at least the proposed draft rule, which is in cold storage for last 8 to 9 months, where it is linking it to the date of agreement. Otherwise, there will be an issue in that case. For primary adjustment determined based on the, the fourth is safe harbor, which we all know that where you have adjusted based on the safe harbor, the adjustment has been made and the income has been offered. Fifth case is the MAP case, where it is determined under the DTAA. Now these MAP cases are only transfer pricing cases. If I considered a MAP addition for international transaction, TDS provisions or something else, then the secondary adjustment would not trigger. Secondary adjustment would trigger only for transfer pricing cases. Just let's look at the time limits which they have prescribed and then we move on to the main issues. Time limit for repatriation sub-rule 1 gives us the time limit for 90 days, when the 90 days limit will be there. So it gives us the time limit to repatriate the funds back to India. Sub-rule gives rate of interest. That's all the rule provides. It doesn't provide anything more than that. It doesn't say how you will really compute interest. It doesn't give a start date, end date. It doesn't even say that if you receive the money, you will reduce it from the secondary adjustment. So possibly one smart officer would take a view that even if you receive, I will not reduce it from the secondary adjustment because the rule does not specifically provide. The rule says once this is triggered, the interest will be computed in perpetuity. No doubt the logical conclusion is I have got the fund, so it should reduce it. That's only a logical conclusion. The rule doesn't provide for it. That would be a case which requires a clarification from the board, or at least amend the rule to say that if you receive the money or interest is calculated up to the date of receipt of funds. Then in case of suo motu return or where it is safe harbor, the time limit of 90 days starts from 139(1), due date of filing return. Here it is the due date of filing return, not the date of actual filing of return. So you may file the return in October or in March, but the due date will always be linked to 139(1). due date, as may be the case, if it gets extended, that extended time limit should be available to me. Where I am accepting based on the assessing officer, now here is where the issue would come, which we'll discuss in detail, that the section says addition made by the assessing officer. The rule says the 90 days will be calculated from the date of the order of the assessing officer or date of the order of the appellate authority in which this aforesaid primary adjustment is determined. Now, appellate authority is not there in section 92 CE, but it is brought in the rule. To that extent, there is an inconsistency in that. Next comes the APA. Now look at this particular provision. It says the current as it stands today. It has not been modified yet. It has not been modified yet. It says that 90 days will be calculated from the date of return of income. Now this provision just does not take care of the practical situation. If I file an APA today, or I would file it say in March, for 5 forward years and 4 rollback years, if I opted for rollback years, the time limit of rollback years of 139(1) is already expired. So how do you calculate 90 days from that expired period? Right? So it just doesn't work, because you cannot go back now to 2016 or 17 and start the calculation of interest. They have not taken care here to provide that it should have been based on the date of APA agreement, which is now provided in the proposed rule but still not notified. It also does not take care of the forward years, because if you file an APA in March, it may take 2 years to negotiate. And your due date of 139(1) would have already lapsed. You would have possibly filed return for 2 years, 3 years, 4 years. There are cases where APA is not concluded even for 4 years. So if you link the time limit to 139(1), then there is an issue, because the calculation of interest will go back to the first year if it is a rollback year, which would be good amount of interest or very significant amount of interest, which has not been taken care in the existing rule. The amendment which is proposed says that we will link this to the date of the APA agreement. Now, when you link it to the date of APA agreement, so it takes care of the backward years or the rollback years. It also takes care of the years in which you have actually filed the return. For the forward years, possibly we'll have to take a logical answer saying that I would have anyway billed as per APA and have not passed a separate entry for the excess amount. So if my existing agreement is say cost plus 12% and APA is done at cost plus 18%, that's 6%. I've anyway invoiced it along with the cost plus 12%, though the actual agreement with the AE may still be cost plus 12%. There could be a situation that kind of, so if this 6% additional is billed and invoiced along with the your actual invoices which you are doing as per your agreement, or at least as provided in the APA agreement, there should not be a much problem. Then the primary adjustment itself should not trigger, and therefore this 92 CA should not be applicable for forward years. So in those cases, if the billing is done in accordance with the APA agreement, that should be taken care. In other circumstances, we do not visualize that you will not do it the billing in accordance with the APA. There could also be practical difficulties, like in some of the APAs we have seen that there may be multiple entities with the APA is done. You have done an unilateral APA. At the year end, you may just bill it for one entity for the difference of that 6% which is there with the multiple entities. So that kind of a situation, this particular provision could still be a problematic, because the additional billing is done only say at the end of the year in March month for all the entities. How that will be acceptable could be an issue. In case of MAP, the existing again clause says 139(1), which is again weird, because the MAP could happen after the assessment order is passed. Assessment order will be passed after 2 years after the closure of the assessment. MAP would have been done another 2 years down the line, and linking the time limit to 139(1) just shows that the person who has drafted the rule has not looked at the actual situation which is there on the ground. Now they wanted to link to the order giving effect to under Rule 44H, which the EO passes in consequences of MAP order. So that is much more sensible thing, that you will get the funds within 90 days of the MAP order. These are the interest rates which are there. Now let's come to the main aspects. The first issue that arises is, what is can secondary adjustment itself be done? One way to look at it is, there is no amendment to section 224 in definition of income, which says that this becomes your income. There is no amendment to section 4 with section 5 to say that the accrual of income concept is changing. We need to make a qualitative difference between the existing transfer pricing provision. Section 92 says income arising from international transaction shall be computed having regard to arm's length. To that extent, the existing transfer pricing provisions are only a computation mechanism. They are not charging provisions. They are only a computation mechanism. That means if I have sold at 100, I want to make it 120. Or if I have purchased at 100, I want to make it 90. To that extent, they are only a computation mechanism. They are not charging provisions. Now, in the existing provisions of transfer pricing also this challenge remains, because there is no amendment to 224 or there is no amendment to section 28 or 45 or respective heads of income. The charging provisions of each head of income do not really incorporate the transfer pricing reference to section 92 in the respective heads of income, especially in section 28. That problem remains there also, but it is more aggravated when it comes to secondary adjustment. The provisions are not very strong as it stands today. They may amend it, possibly retrospective, possibly prospective. That all is in womb of future. But what the provisions stands today are very clearly open to challenge that there is no charging provision and computation mechanism fits. For a couple of reasons. As I said, there is no amendment to section 224. Doesn't say that this becomes your income. There is no amendment to section 4 and 5. There is no change in the concept of income or accrual or arisal. Section 4 or section 5 would say that income that accrues or arises to the assessee or received or deemed to be received by the assessee is taxable. Now, in a secondary adjustment, does the income really accrues to the assessee? The Supreme Court in E.D. Sasan's case 26 ITR 27, further strengthened by Supreme Court in Excel Industries, very clearly says the accrual would happen when there is a right to receive by the assessee, plus there is an obligation to pay by the other party. If there is not there is no right to receive by the assessee. In that cases, you cannot say the income really accrues to the assessee. Whether that test will be satisfied in case of secondary adjustment, do I have right to receive this additional say 20 rupees from my associated enterprises? Is he accepting to this 20 rupees? Possibly no. No one would possibly accept that in most of the cases. So, do I say that I have a right to receive? Possibly that test may not be satisfied. This would be one ground under which it will be open to challenge. Second, under which head you will tax it? Will you tax it under profits and gains of business or profession? It's an interest income which we generally offer under income from other sources. What if the underlying transaction is a capital gains? The underlying transfer pricing, international transaction is a sale of a share, and then the ALP of that sale of a share between associated enterprises is recomputed. So I have sold the shares at 1000 rupees, it is recomputed at 1200 rupees. Then 200 rupees is the receivable from A as per the secondary adjustment. So that transaction is capital gains. So should I adjust this, offer this secondary adjustment also in capital gains? Again, no clarity there. Section 14, which gives us the heads of income. Nalinikanth Ambalal Modi, Supreme Court in 62 ITR, very clearly said that income has to fall in one of the heads of income based on the classification rule. And if the charging and computation mechanism of that particular head of income does not attract, then that income is not taxable. So that would be the second way to challenge it, that the existing sections, existing heads of income and charging provisions of each heads of income do not really incorporate secondary adjustment within its ambit. That would be second way to look at it. Third very interesting way to look at it is, you look throughout 92 CE or throughout Rule 10 CB, it doesn't even say that it is deemed to be income of the assessee. Nowhere in the whole section it says it is deemed to be income of the assessee. If you see 92 CE, it says that these are the flight losses, you make an adjustment and the assessee will make a secondary adjustment. Right? Subsection 2 says, if you don't receive the money in 90 days, you should compute interest. Fine, I have computed interest. What to do with that interest? They should have clearly said that this interest is deemed to be income of the assessee, which is again missing in 92 CE subsection 2, which is again a drafting lacuna. I hope they strengthen it. But till that is done, it is again open to challenge in that particular clause that it is not properly capturing the essence of purpose. 92C, whether it will override section 4 and 5, respective heads of income, it doesn't open with notwithstanding anything contained in any other provision of the Act. So it becomes a standalone charging section and computation mechanism without backward linkage to any of the heads of income. So to that again, there would be an open to challenge that when there is a conflict between the existing charging sections 4, 5 read with respect to heads of income and 92 CE, and which will override what? And given that there is no backward linkage to the respective heads of income, that would be open to challenge under that count also. So these would be some of the things that one would look at once we are saddled with the liability of secondary adjustment. There would always be an assessee who is ready to take a risk of fighting the battle. For those cases, these are the arguments which we need to build. Look at it further way. Now the law envisaged what would be the counter arguments for this, that it is an income. What does the provision say? That assessee shall make a secondary adjustment. The secondary adjustment is an adjustment in the books of account. That means I should pass an entry. So let's assume that I pass an entry for P&L account credit and debit the receivable. Debit the AE from whom I should get this amount and credit the P&L account. Let's assume that this particular entry is passed. Now law mandates me to pass this entry. So it is saying that assessee will make a secondary adjustment. So suppose I make this adjustment entry. Will any auditor certify this balance sheet? This receivable, is it really that I am going to get? Is he going to give a qualified report saying that this receivable, the assets of the assessee are inflated to that extent, therefore it is not there. Next, when should I pass this entry? When I did the original transaction? Possibly no, because that time I may not even know, especially where the addition is done by the assessing officer. Should I make this entry at the time when the assessing officer passes the order? Should I make this entry when this 90-day period lapse, or the due date, or I have accepted when I don't file an appeal to the authorities? So when is the point of time when you really pass this entry? That would again nowhere the law says. It only says make the secondary adjustment. Fine, I'll make in someday in future, but not now. Okay, that is again. I mean, there's no guidelines in terms of when you will really pass this entry. Now let's assume I pass this entry. P&L account credit, receivable A, receive. Is this receivable which will really come? Can I write it off? If I write it off, can I claim a deduction under 3617?
Yes.
So if I claim a deduction under 3617, then secondary adjustment is the most favorable provision. Because the primary adjustment is 20 rupees, I credit to P&L and I have offered to tax when the TPO made an adjustment. Then I claim the credit, show it as a receivable. Now you cannot say it is not a debt because the law deems it to be a debt. Is it irrecoverable? Yes. If I write it off, have I satisfied the condition of 3617? So then I should get a deduction under 3617. Another proposition to convert an unfavorable provision into a favorable provision. So knock off the primary adjustment, claim a deduction for this entry, make a credit entry in the P&L account, possibly in 1 year, write it off in next year and claim the deduction for that. One way of looking at it at this particular provision. See, these are all laws is clearly there is no provision or clarity on these things. So these are all thought processes that we need to build. Again, the AO will possibly disallow it, but if you read the plain language of 3613, what does it provide? There is a debt which is irrecoverable and the assessee has written it off, which has satisfied all the conditions of 3617. Another condition is that this should have been offered as income in the earlier year. That also I have satisfied because I have either done a suo motu adjustment or the AO himself has added it. Right? That is one, again, another way to argue that I should get deduction for this 36173 under 3617 by writing off this debt in one particular year as and when that particular event arises. I possibly see a year in which there is more profit and write it off. If I don't pass an entry, what happens? Again, there is no specific provision to levy a penalty for not passing this particular entry in your books of accounts. So to that extent, there is no penal provisions which will get attracted. There are a lot of issues that will arise, that how do I make this adjustment? Do I make only in the return of income? The 3CD has been amended under clause 30 capital A. The auditor need to certify what is the secondary adjustment computation and he needs to give the figure of interest computation in the that clause. So does it mean that computation mechanism by providing in 3CD has been triggered? So these would all come up in the particular case to be tested at the level of court. But so if the entry is passed and written off, that would be one interesting way to look at it. This is on the charging provision. Now we go to the computation provision. That why again we can argue that the 92C fails on computation provision. Now look at this particular section. As I read rule 10CB says that under sub-rule 1 it says that you should get it in 90 days. Sub-rule 2 gives you the rate of interest. Per annum, this is the rate of interest. 92C2 says if you don't receive in 90 days, you will compute interest as prescribed. For computation of interest, what is required? One, the base amount on which I will calculate the interest. Second, rate of interest. Third, the start date and end date. When I should start and when I should end. Does 10CB3 provide what is the start date and end date? It nowhere says that you start computing interest on 91st date and stop when you really receive the amount. If the 90 days end on, say for example 28th of February and I receive money on 3rd of March, will you compute for 3 days? Will you compute for part of the month, making it whole of the month, or will you ignore 3 days? Law again is silent on that, because you have specific provisions that when part of the month becomes a month, or when part of the month has to be ignored. Now here there is no specific provision for that, and the worst part is they have not provided that if you really get the amount, you should stop the computation, which should have been provided in the rule that if the amount is received, then you will calculate up to the date of receipt of funds. So can it be argued that the computation mechanism is not concrete in terms of clearly providing what are the 3 limbs? Should I start from 91st day? Possibly one way to look at it. Should I go back to the due date, which is say 139.1? For example, in 201.1a, where you default on TDS, you don't start at the end of the day, you don't start from the 8th day. If it is 7th March, you don't start from 8th March, you go back to the date of transaction because the sections clearly provides. So that is also one way to compute interest. Should it go back to the date of invoice because government lost that funds from the date of invoice? So there could be these kind of difficulties in computing interest. As it stands today, possibly all of us will take the most favorable view started from 91st day because that is the least period that the assessee will be applicable. But otherwise, possibly it will be open to challenge that the computation mechanism of interest itself is not provided in the section and therefore the computation mechanism fails. That would again be one of the ways to challenge it. Suppose assessee doesn't make the secondary adjustment. He doesn't compute this notional interest on the fictional advance. Can the assessing officer do it? Can the TPO do it? Which officer will do it? One of the questions in the case study we have raised one circumstances where the TPO says that I will make the secondary adjustment. What is TPO's role? TPO's role under 92C is only computation of arm's length price. He is just a subcontractor kind of thing who has to do within the scope of work what has been given to him by the assessing officer. The assessing officer make a reference that you please compute the arm's length price of international transaction or the specified domestic transaction. He has no role to play on the secondary adjustment. The secondary adjustment can only be done by the assessing officer, not by the transfer pricing officer, not by the TPO under section 92C. 92C read with 92CA, the TPO's role is only restricted for computation of arm's length price and not for secondary adjustment. Then the next comes is the what or most of the cases that would fall in this particular category. What do you mean by addition made by the assessing officer and accepted by the assessee? When do you say assessee has accepted it? Or how do you going to look at it? First difficulty, as I made a statement, this section says assessing officer. The rule says order of the assessing officer and order of the appellate authority in which the aforesaid adjustment has been determined. So that means they know that an adjustment can be determined by appellate authority also. Given that two different phrases are used in one assessing officer and appellate authority, that means clearly these are two different bodies. That means they visualize that these are two clear different bodies. Assessing officer is defined under 27A that he might be an DCIT, JCIT or has who is given authority to do the assessment. Appellate authority is not been defined. Can High Court or Supreme Court be an appellate authority? They are not appellate authority, they are courts. The appellate authority is CIT appeals or income tax appellate tribunal. So can we now look at an argument that if I file an appeal to the High Court, that means I have not accepted, or at least the computation mechanism fails, because the 90-day time limit is from the assessing officer's order or at the most from the appellate authority's order. It doesn't say 90 days from the High Court's order or Supreme Court's order. So that would be again one area of interpretation that one can take, that it is not applicable. Second, when there is a conflict between act and a rule, all of us know, at least legally we know, that the act overrides. Nowadays forms override the act. What is provided in form, because it is provided in the form, you have to fill it up, otherwise it doesn't get uploaded. So to that extent, form override your rules, notifications and the act. But at least legally, at least in a court of law, the act would override the rule. And when the act has very clearly used the word assessing officer, then in my opinion, we should take a view that where an addition is made by assessing officer, only that addition will be sustained. No other additions can 92C be applicable. Lot of interesting ramification can arise because of this. In one of the examples I have given, addition made is 80 lakhs enhanced to 1.2 crores by the CIT appeals. So what was 80 lakhs was by the assessing officer, it is below the threshold of 1 crore rupees, which is not, again, so that 40 lakhs is not at least made by the assessing officer. That is one. Second, as I move up to CIT appeals order or CIT appeals or tribunal, the doctrine of merger needs to be respected. Which is the order that survives? Is it the order of the assessing officer? Is it the order of the CIT appeals or tribunal or High Court or Supreme Court? It is the order which is the order that can be enforced. Is it the order of assessing officer that can be enforced, or is it the order of the CIT appeals or tribunal, etc. that can be enforced? The order only that can be enforced is the order of the higher authority, between the CIT appeals tribunal or High Court or Supreme Court. Therefore, based on the doctrine of merger, once I have filed an appeal to the higher authority, we should be able to argue that it is no more an addition made by the assessing officer, it is an addition which is based on the order of the CIT appeals tribunal or the higher authority. Look at it from another angle also. We have clearly provided part merger theory in 147, 154 or other provisions unlike 263, where we have clearly said the issues which are not covered in the assessment order in the appellate jurisdictions, for those cases the reopening can be done under 147 or the 154 rectification can be done. So that principle also we should be able to argue that because of merger theory, once I file an appeal to CIT appeals, it is that it is an order of the assessing officer, it is an order of the higher authorities. One way of looking at it. What happens if I go to DRP and then the EO passes a final assessment order? Is it an order of the EO because he has passed the final assessment order, or is it an order passed in pursuance of directions of DRP and therefore it is not covered under 92CA? Possibly here we are at a slightly weak footing, because finally the order which survives or which is enforced or which creates a demand is the assessing officer's order. Possibly again to argue, because 144C uses very interesting word. It uses word, if the assessee, once you get a draft assessment order, you will file objection to the DRP. Objection is exactly reverse of acceptance. So that means I have filed an objection, therefore I have not accepted it. But that will be against the draft assessment order. The enforced is the final assessment order. To that extent, we would possibly in weak footing. What happens when the order is by CIT under 263, 264? Is it an addition made by the assessing officer, or is it an addition made by the commissioner under 263, 264? So when you are saying that addition is made by the assessing officer, possibly in 263 or 260, not 264, but in 263 scenario, it is the order giving effect to the 263 directions, which will be the order which we will look at for 92C purpose, and still it should trigger. So that would still be something which we should look at it. Another interesting issue that arises is when an order giving effect to is passed to tribunal order or to the CIT appeals order. Now I go to CIT appeals or I go to the tribunal. Tribunal sends it back to the assessing officer. Now the computation mechanism says 90 days from the date of appellate order. But only tribunal order will not determine the liability. The liability will actually get crystallized when the order giving effect to that tribunal order is passed. Because the tribunal may say, okay, relook at working capital, give it accordance with law. How do I know what is the transfer pricing liability or the addition unless an order giving effect to has been passed? And we all have experienced that order giving effect to are never passed. Right? So if we link the time limit of 90 days to the appellate order, whereas the final computation is coming in the order giving effect to because of directions given by the tribunal, again there is an anomaly here. I would never be able to compute what is the actual transfer pricing transfer pricing liability, and then how much of funds I should get within that 90-day time limit. So again, to that extent there is a gap in terms of drafting. It would have been better if it was linked to the order giving effect to rather than the appellate order, which appellate authority, the few word used in 92 CB. These are again be cases where one could look at challenging or saying that this really doesn't function because these are the gaps in the drafting. These are some of the issues, though not specifically raised in the one of the issues is raised, but others are not really raised in the questions. When there are multiple associated enterprise, so if I'm a car manufacturer, I may have 100 associated enterprise from whom I am purchasing parts, and if I am accepting the transfer pricing addition under TNNM, where you have not pinpointed to whom it should come, whether all of them should give, if I get it from one party, is it sufficient? Again, a lot of debate can happen on that, who should really give me the funds. From India's perspective, possibly we said, to the extent I get funds, India should be happy. But it is not that every assessing officer will be satisfied with it. So if I have 3 parties and addition is proportionate to 3 parties and only one party gives fund, it's the all probability assessing officer will take a view for balance to secondary adjustment is applicable. Right? So again, open to gap. Very interesting would arise where it ceases to exist. One of the cases I have given that it is liquidated and therefore there is no real associated enterprise itself. So in those cases what would happen? The law does not visualize stoppage of computation of interest. As I said, computation of interest is in perpetuity. Even if there is no associated enterprise relationship, the section or the rule as it stands today, the secondary adjustment will still continue. There is no restriction or no stoppage just because the AES ceased to exist. This becomes more interesting if it's a deemed international transaction. It is totally with a third party. Why will he give my fund? Where my sister concern is only not giving me fund. Why will a third party give me the fund? So, to that extent again, there will be a problem.
So in this case, successor and merger happens, right? Successor.
No, not merger, say it's closed down.
Yeah, closed down. Successor, whoever owner is there, he will be here. So I think a lot of laws are there, right?
So if the successor has taken over that liability as per the merger agreement between them.
So owner, not the owner. Whoever is the owner, he closes the company.
Liquidation.
I have given an example of liquidation.
Liquidation. It's a liquidation. This company is not there.
There could be various circumstances. Liquidation is one. Second, it moves out of group. I have sold that business. It is no more an associated enterprise. Then what happens? Merger, it may still remain in a group. Or it could be a new party which becomes my associated enterprise. But when, suppose it is moving out of a group because I have sold that business, it is no more an associated enterprise. Then what happens? So these are again various issues that would arise on that point also. Can you approach for MAP under TTAA for secondary adjustment? No. The MAP under TTAA will only cover your primary adjustment. It will not cover your secondary adjustment. So you cannot even go to a MAP for the secondary adjustment. You will have to resolve the secondary adjustment issue in Indian courts only. You will not be able to take the benefit of MAP for the secondary adjustment. Therefore, it is necessary that we challenge this provision. Some of the other issues that we need to look at is whether it will apply to deemed international transaction. If you look at subsection 1, 92B1 and 92B2, both are qualitatively different. Under 92B1, we first see whether there is an associated enterprise. Then we see that whether that associated enterprise, at least one party is resident, non-resident. And then you see whether you are entering into a transaction with that associated enterprise. If these conditions are satisfied, then it becomes an international transaction under subsection 1. Subsection 2 does not start in that way. It doesn't deem a party to be an associate. It is only directly attacking a transaction, not an associated enterprise. So what is saying that a transaction with a non-AE will become a transaction with a AE if XYZ conditions are satisfied. And then it is deemed to be a transaction with a AE. So deeming fiction is created under 92B2 only for that transaction. So if with the same third party, if I have 5 transactions and deeming fiction or the conditions of 92B2 are satisfied only for one transaction, balance 4 are not international transaction or deemed international transaction. So to that extent, 92B1 and 92B2 are qualitatively different. 92B1 says international transaction means. So they have said that this is international transaction. Only difficulty we would have is 92B2 says for the purpose of subsection 1. So are they saying that we are now saying deemed international transaction also pulling it into subsection 1 and say that it is deemed international transaction and between the associated enterprise? If this for the purpose of subsection 1 is extended to say that I am pulling subsection 2 transactions also in subsection 1, in that case we will have a difficulty to say that the secondary adjustment is not applicable to international transaction or not applicable to deemed international transaction. But when you look at other things, for example, the associated enterprise, it is only what can fall under 92 capital A, nothing else. Funds lying with excess money with the associated enterprise. They have not said excess money with the deemed associated enterprise under 92B2. So then there is no funds lying, that is not been brought in under 92CE2. So that extent again there is no coverage. 92CB still to that extent covers deemed international transaction because there the international transaction is defined under 92B. They have not said subsection 1 or subsection 2, they have just referred to 92B. To that extent there both subsection 1 and subsection 2 would come. But looking at various clauses, it is possible to argue that the deemed international transaction are outside 92CE and the deeming fiction should not apply because subsection 1 and subsection 2 of 92B are qualitatively different and they are not one and the same thing. Branch of a foreign company. This is not an issue which is unique to secondary adjustment, but it is an issue independent by itself. When there is a HO outside India and a branch in India, the branch is a permanent establishment. The definition of enterprise includes a permanent establishment. To that extent, a branch is an enterprise. No dispute on that. We possibly cannot argue on that particular point. 92, or to say chapter 10 nowhere uses the word person. It doesn't use the word person really in most of the cases, whether it is 92A or 92B. It uses the word enterprise through and through. Because if the word person was used, then the question would arise whether a branch and HO are different persons or they are one persons. If they are one persons, we have the special bench decision of Sumitomo Corporation in the context of banking interest paid by a branch of a foreign company, Indian branch of a foreign bank, where they said it is payment to a self and TDS provisions will not be applicable, disallowance will not be applicable. But when it came to deduction, they permitted deduction under the treaty. So that that particular case law is a 5-member special bench tribunal decision, a fairly detailed one on this concept that when there is a HO in branch, what would be the implication. So here they have not used the word person. So I don't know how much we will be able to rely on that decision of Sumitomo Corporation Mumbai Special Bench. But can I then say that are they really an associated enterprise? The associated enterprise under 92A1 says that there should be 2 enterprise, 1 enterprise having capital control or contribution in capital control or management, and subsection 2 looks at 2 investee enterprises. Subsection 2 opens with the phrase, for the purpose of subsection 1, following shall be deemed to be an associated enterprise. There are clauses A to M. There are 2 arguments that is there. That means to be an associated enterprise, I should fall in subsection 2, clauses A to M. If I am able to demonstrate that, if I am not falling in any of the clauses in A to M, I am not an associated enterprise. So if you look at all the clauses in A to M, there is no clause which says HO and branch is an associated enterprise. There is no clause covering this particular relationship. There is a residual clause, possibly they may prescribe any other benefit of mutual, any other relationship of mutual benefit, that which has not been prescribed until date under 92B to M. To that extent, the existing clauses of 92A2 do not really cover in the relationship between branch and HO, and that is not really captured in the definition. So there, This argument is not unique to secondary adjustment, possibly will apply to transfer pricing also, that I am not an associated enterprise because I don't fall in 92A2, therefore the test of associated enterprise itself is not satisfied, therefore no question of either primary adjustment or secondary adjustment. If you look at the questions or year-wise questions which were there, these are framed, or the answers are possibly framed keeping in mind possibly a bit if the view which I hold, that if I file an appeal, I have not accepted the additions, and once the order is passed by an appellate authority, then I am out of the 92C provision, which I feel is a fairly debatable proposition, which we should take it up when we are saddled with the liability under the 92C provision. First and second, not much of a difficulty because it's a suo motu adjustment or an adjustment as per safe harbor rule. It is also exceeding 1 crore rupees, which is the threshold prescribed under 92C. To that extent, there's not much we can do about it. DRP directions, I already said that when there is a DRP directions, the real liability is crystallized, or what is the order that is enforceable is the final assessment order. In that, so there we may not again have much of a challenge that we could do to the secondary adjustment. When you come to the fourth year, where assessing officer has made an addition of 80 lakhs, which has been enhanced to 1.2 crores. So the threshold is really broken when the CAT appeals has made the addition. Possible to argue based on my view that when the appeal has filed, this provision should not be applicable, to say that this is not the secondary adjustment is not applicable. No doubt the CAT appeals, his powers are co-terminus with the assessing officer, but he is still not an assessing officer. He is still a CAT appeals only. You cannot tell that CAT appeals. We can ask him. You can say him that he is an assessing officer, and you can see a reaction. You will realize that he is not an assessing officer. He is a CAT appeals. Next, whenever I have gone to tribunal, whenever I have gone to high court, there could be we could take a view that the provision is not applicable because it is not an addition made by an assessing officer which I have accepted. It is an order of the tribunal which I have accepted, not an order of the assessing officer which I have accepted. Not much of a difficulty in ICO 2, we have similar provisions. Only when the APA is finalized in Jan 2022, for the period from April to Jan 2022, for that 10-month period, the 90-day limit will be calculated from the date of agreement. Though you have really raised the invoice in March or subsequent to that, the true-up invoice for APA purpose you might have raised subsequently, up to the date, up to that point of time, for all the earlier one, the time limit of 90 days has to be computed from the date of signing the agreement, which is happening subsequently, that is the subsequent period of APA. Assuming I am invoiced in accordance with the APA itself and accounted in my books of account, the question of primary adjustment and secondary adjustment itself should not arise, and therefore this section, this particular provision should not be triggered. Branch, I have already addressed this. Okay. What would happen in the year of receipt? How do we account this or accept this in the year of receipt? Will it be liable for normal taxation again? Will it be liable for MAT taxation? Normal taxation fairly, not much of a difficulty because I really offered that income and it's only an entry which I may pass in my books of account, or entry also might have been passed and I will receive that amount at that particular point of time, which I will knock off against the receivable. When it comes to MAT liability, in the year in which I pass the entry, or if I am not passed the entry in the year which I receive, can I directly take to the balance sheet capital reserves or general reserves, directly bank account debit, credit general reserves, or the bank account debit or credit P&L account? Which would be permitted? Possibly it will depend on who is the auditor and he will permit what. Yeah?
Section, how can?
Section again does not really say anything. Now if I go to the MAT computation, I start from the profits which are there in books of account. I can only make an adjustment which are permitted in the section. I cannot really go beyond those adjustments which are permitted in the section. And you cannot tinker with anything else because of Supreme Court decision in Apollo Tyres. You need to really take the books of account, start, make additions and deletions as per the 115 JB. Again, in the year in which it was offered for normal taxation, anyway we had not offered it for MAT taxation. To that extent, possibly the argument would be that it is liable for MAT. Naturally, we can, if there is a MAT credit which is available at that point of time, one could carry forward and set off. But if you go by 115 JB provisions itself, there is no plus or minus provided for secondary adjustment. To that extent, we may not have a very strong case to say it is not liable for MAT. Only possible way to argue is that it is a capital receipt. We do have some decisions, though again may not be very sound decisions to say capital receipt is not liable for MAT. We have cases where in long-term capital gains we have said that it is not liable for MAT. Capital subsidies are not liable for MAT. Those decisions one will have to take recourse and possibly argue that I will not be liable for MAT. Otherwise, the way today the section provides, as and when I pass in credit entry to the P&L account, if the auditor permits it to pass it to them, I am not good at accounting standards, so I don't know our company law to say that it can be directly taken to general reserve. But if it can be taken to general reserves, as we used to do many an occasion earlier, their possible argument could be there. 10 AA, can I get a 10 AA on this? Again, a very interesting proposition. Suppose I am an SEZ unit, I myself make a secondary adjustment, offer it to the tax, and can I say that I will get 10 AA on it? The existing 92C4 proviso says that if an enhancement to the total income is made by the assessing officer, you don't get deduction under 10 AA. It in fact doesn't even cover the enhancement made by the assessing suo motu. We have Bangalore Tribunal decision in IGATE and followed by many other decisions, and IGATE has been confirmed by the Karnataka High Court, which said that this the deduction should be available. So in the case of IGATE, a suo motu adjustment was done to the total income by the assessee itself in its return of income, and on that additional component of TP adjustment, primary TP adjustment, assessee claimed 10A deduction. The argument of the assessee was, where is the restriction? The restriction which is there in proviso to subsection 92C4 is only when the enhancement is made by the assessing officer. Now the enhancement is not being made by the assessing officer, therefore I should be eligible for deduction for this enhanced income. The tribunal gave the deduction, which has been upheld by the Karnataka High Court. That's an interesting proposition, but the main question which will arise is, if this 10 AA, one, under which head it is taxable? Is it taxable under profits and gains of business or profession? If it is taxable under business or profits or gains of business or profession, will it take the character of profits of the business of the undertaking under 10AA8? If I don't get the character of profits of the business of undertaking, this notional item which I am now bringing it to my P&L account or bringing it to the taxable income computation under the STI, statement of total income, can I say it's a profits of the business of the undertaking? We can possibly make an alternate arguments. Say, look at decisions of GEM+ or many other decisions. Any disallowance you make becomes profits of the business of the undertaking. It becomes part of your total income. Therefore, deduction is available. Disallowance, there is a circular for Chapter 6A deduction. So, there is a disallowance, you get Chapter 6A deduction on that or 10 AA on that. So, they have said that what is relevant is the income has computed under the head profits and gains of business or profession. Now, if the tax authorities are going to say the secondary adjustment is taxable under the head profits and gains of business or profession, assuming the underlying income is business income, then can they say that I will not get 10 AA? If they say it is not taxable under profits and gains of business or profession, anyway it is not taxable. Right? So if you make an argument that it is taxable under the heads of profits and gains of business or profession, the GEM+ decision, subsequent various other decisions which have followed that line of thinking that any computation which is coming, disallowance is coming under 28 to 44D is eligible for 10A, that I would be able to take recourse to that particular decision and say that it is eligible for 10 AA. Again, this would be an argument which would be debatable, but possible proposition to say that I will get an additional deduction on 10 AA on this income, and it will be added only to profits of the business of the undertaking. That I will make an addition to that, and it goes to the formula of computation. Otherwise, if you don't apply this logic that it falls in the profits BGBP, and I should get or not get it. If it goes to iOS, then I possibly not get it. It's not profits of the business of the undertaking. But if they want to tax it under profits and gains of business or profession, the natural corollary of tax computation is that what is the profits and gains of business of the undertaking? That head income multiplied by export turnover divided by total turnover is the deduction that we today get. And I mean, many of you have experienced that disallowance is made. I have been getting 10A on that. If you ask intrinsically, does this have anything to do with business? No. It is a fictional item. As I said, it's a fiction on fiction on fiction, which has no link to the business. It's a legal fiction which has been created. And can you extend legal fiction to that extent? So now we created a fiction of income, then advance, and then interest, and then deduction. So it's another fiction that we are creating now to the extent to complete the entire theory on that particular point. So it could be one of the ways to look at it that I claim this because it falls in profits and gains of business or profession. So this is on case study 1, my thoughts on case study 1. I guess, go for some more time. Shiva sir, I can go for how many more till the audience are ready? It's okay. So even I am told that most of the groups discussed only case study 1. They have not been able to discuss case study 2 and 3. I'll briefly try to touch upon this, or at least give the main theme of the case study. The case study 2, we face this difficulty in day out in outbound structures. It is not just software services. It could be a simple manufacturing entity which has in India but which has business outside India, and it wants to do marketing for that business outside India. So those cases, how do you look at creating a viable business model? It is not just transfer pricing, it is connected with various other aspects. One aspect is the funding for the transaction, because in this case we are taking an example that it is an Indian residents who are there in India. So if you have a subsidiary outside India, at least in initial phases the cost of marketing will be pretty high. Or if there is a product which requires longer period or a longer maturity period in terms of fetching the sales, in those cases the initial few years the cost of marketing could be high. And when the cost of marketing is high, how do you fund it? How do you fund the subsidiary? Because your FEMA restrictions may come into picture, or other restrictions may come into picture. Second, every time you fund it with capital and you have a loss outside India, that loss is not deductible in India. So you end up paying taxes in India possibly and having losses outside India. So that is one aspect. Second aspect is the transfer pricing that we need to look at it. Third aspect is the tedious provisions if I am making a payment outside India. In this case, the commission and the marketing fee, if I'm looking at the second case. Fourth aspect is the GST angle. Though in most of the cases, the marketing should, the place of location of service should be supply should be outside India, and it should not be liable for GST. But that is also one of the angle that you will have to keep it in mind while you are doing this particular structuring, or what model one should adopt. Second aspect is the business aspects. The clients may not always have comfort with contracting with India. They may want to have contract with your subsidiary outside India or the US company itself, because they may not want to have a contract with the Indian company. In initial phases where you are not well known, they may want to have contract with the local entity, so that in case there is some issues in terms of actual execution of the work, if they want to sue, it is more easier for them to do the recovery against an US company rather than doing it from Indian company. So there could be that difficulty also that we need to visualize if you are doing an outbound structure, and what should be the transfer pricing and compensation model from the business perspective. I am not touching upon the aspect of a branch, because you could still also have a branch instead of a subsidiary. In that case, really the funding and other issues or the payment of commission, those issues may not arise. But branch would have its own risk in the other country, because the liability of a branch makes unlimited. It can attach to the Indian assets. A lot of countries do not permit a branch. It's like China do not permit a branch. So there could be difficulty in really setting up a branch in those cases. Otherwise, branch also could be one of the options that we could look at. Just to highlight at a broader level that what would be the issues. It's a first case where we are assuming that India functions as a cost-plus model. This would be similar to what captives which are we have of US companies in India. There would not be much difference in this. It's a straightforward model. But the challenge that would arise here is, one, the compensation model that you would have for India. You do it a cost-plus if you're going to do, and if the really business is not very high, you would have substantial losses in US. Because the US needs to fund India every time at cost plus X percentage. So it requires fund to give the remuneration back to India. If you have a very low cost plus, the transfer pricing addition is a sure shot because the officer would expect a higher level of compensation which is there. So if you have a cost plus, US as a cost plus and India as a cost plus and US funding it again and again, how do you transfer funds to US to give it back to India as a cost plus remuneration is the most important challenge you will have in this particular situation. If the business is matured and you have reasonably good orders and you know that I am going to have reasonable cash flow, then in those cases making India as a cost plus may still be possible, but in other cases it may not really work as a cost plus in a long run where your business gestation period is higher and you require time to do it. This would be other funding constraints I have highlighted. Then there will be no implication in terms of TDS in this case, and it should qualify as export of services. In the second case, here assuming the client is ready to have a contract with the Indian company, there could be situations where the client may not be ready to have a contract with Indian company. Then you need to still have the US contract with US company with a back-to-back arrangement with India. You can have two types of contracts where this is happening. Now, if you start remunerating US at a cost plus, that means the revenue, entire customer revenue comes to India, either directly from the customer or through US on a back-to-back basis, adopting a different contractual model. Then you remunerate the US entity on a cost plus. What are the challenges? When you start remunerating the US company on a cost plus, two difficulties that we need to, or two to three difficulties that arise. One is where the US starts becoming cost plus. The amount of expenses that are going to get debited in Indian books in the initial years where there are not much orders or where there is not much of a revenue, for example, and you are in a startup phase or an initial phase, you do not have a real profit. In those cases, the profits will move out of, or the amount of profits, the US will still make a profit and India will still make a loss. And you know how the tax officer is there, he has allergy to losses. And naturally it is going to get challenged that the amount of marketing fee paid to the US company vis-a-vis the orders he has generated will not possibly match. Suppose he has generated a rupees 100 order, but his cost is 50, and if I am adopting cost plus 50, cost plus 10%, I would have paid him 55 rupees as marketing fee. And that 55 rupees as a percentage of sales, I have paid 55% of a sales to the US company, which the tax officer would not accept it. Second difficulty is what we generally see is any payment that goes out of India, the officer today asks, the transfer pricing officer today asks, what is the benefit received? Please demonstrate the benefit. If you don't demonstrate the benefits, the ELP is nil. Right? So that problem will arise in these cases also. The common problem again in Model 2 and Model 3 is when I am making a payment, is it liable for TDS? What is the character of that payment? In our case, the entity is US entity. To that extent, there is a make available clause to protect us. In cases where make available clause is not there, we would have this challenge to justify this. It is a trade-off between transfer pricing and TDS provision. When you pay a higher amount to US company, you have naturally to justify higher payment by higher functions by US company. So you will say US company does a lot of additional things. And when you start saying US company does a lot of additional things, then it will move out of your normal commission or marketing fee to fees for technical services, because now it may be a managerial services. So if you start increasing the profile or scope of functions for US to justify it from the transfer pricing provisions, then you may be hit by the TDS provisions under 917, and it may really become a managerial services, because then you may start saying it does a lot of sales, it manages my customer, it does this, that, to justify the transfer pricing payment or the higher payment which you are making. So that could be one of the difficulties when we are drafting the functional analysis. We need to take care to ensure that the transfer pricing justification doesn't hit me on the TDS front. The problem would be similar for commission model also. Only thing is, in a commission model, the difference would be that it may really, the US company may still require funding, because if the commissions do not absorb the fixed costs. Very interesting situation arises in revenue split. You can refer to the decision of ITC Infotech, where this particular model was accepted. The Kolkata Tribunal confirmed by Kolkata High Court. where they adopted 75%, 25% split. The marketing and administrative functions are done by the US company and UK company. The execution of the software services is done by the Indian company. 75% is paid to the Indian company, 25% is retained by the US company or the UK company for the efforts which it has made. Now, this arrangement based on the functional split, this revenue split was accepted as at arm's length. So this could be one of the models which one could look at implementing it when there is an outbound structure. This will also possibly not affect the TDS provisions, because then I am saying only I am giving up the share of revenue, I am not giving a commission or a marketing fee. So this could be one of the things which one could look at. Quickly take 5 minutes maybe for this particular thing. It's an interesting case study by itself, and if time permits we can do 1.5 hours on this case study. The facts given are really bad. Now the question is how do we improve the facts, which possibly we would have done if we had time. But if the existing facts are taken, the two things that trouble us today is the Circular 6 of 2013 and the OECD Web Section Plan 8 to 10 and incorporated in the OECD guidelines of 2017. The underlying theme is the allocation of profits should go where the economic activity is. Allocation of profit should go where the economic activity is. In our case, the Cayman Island really doesn't do any economic activity. It's just a legal owner of IP without really doing anything. So in those cases, my facts are really weak, because the facts, the way it is given, even the funding is coming from US company. The contract R&D is done by the Indian company, and that is only the legal title is with the Cayman Island. So it would be open to challenge that really India should get who should get the residual profit. Suppose it's a blockbuster product which is there. Then today the residual profits are all sitting in Cayman Island, which no tax authority will like it, and they would want either to move it to US or India. The India would say, especially if we complicate it further to say server is also in India, at least with respect to Indian operations, the residual profit should come into India. Possibly one would argue that the ABC Inc. should only get what it is doing the marketing and distribution function. So to that extent it should be remunerated. The ABC Cayman Island, which is only a cash box, as per the guidelines of OECD, it should only get a risk-free return. And if you adopt risk-free return under LIBOR, it is negative, right? Because the LIBOR rates in some of the years were negative. So how much return it should get? Very minimal. At least if you take Indian rates, it may get 5%, 6% return, not beyond that for the funds it has provided. So the cash box really doesn't get anything. From the residual profit sitting in Cayman Island at tax haven, it could possibly move to ABC India or ABC Inc. Even if you see the Circular 6 of 2013, if you are transacting with a tax haven jurisdiction, in those cases they are saying your contracts need to be re-looked at, your transaction needs to be re-looked at it. They are not happy with where you are transacting with the tax haven kind of a situation. No doubt the way they have drafted the tax haven, they have said has notified under 94 capital A, where nothing is notified as of now, right? So to that extent, we could look at lot of this, but the DEMPI functions which are there in Web Section Plan 8 to 10 and were incorporated in OECD guidelines 2017, who is doing the development, enhancement, maintenance, protection or exploitation of IP, and the return will have to be split in these cases based on where the economic activity has happened. Possibly in all these cases where this kind of a situation is there, profit split method would trigger in most of the cases, and possibly that would only be a solution in those cases. India would get characterized as a contract R&D, or it would get elevated to an entrepreneur or somewhere in between that. And you can refer to the Microsoft's decision, Microsoft R&D Delhi Tribunal, where because the Indian entity, Hyderabad unit, the software development unit, was doing a lot of product development, having a lot of patents registered in Indian company's name, they said the characterization is slightly higher than the software services. It is really an R&D unit, research and development, doing high-end activity, not just a software service provider. And if you get patents in Indian company's name, and they went through the patent applications and saw that the patents are of a certain particular activity which doesn't match with the assessee's arguments. Assessee's arguments, I am doing only coding and testing. But the tribunal said if you're doing coding and testing, how did you get the patent? Right? So that would something which we need to be very careful that the actual conduct vis-a-vis what is there in the documentation, that would possibly move the returns higher in India, and only solution in my view would be profit split method. There are a lot of guidelines which are coming up now by OECD and how to actually do the profit split method, and that will have to be looked at. I think we'll close with that. Thank you everyone for patient hearing.
Thank you, Narendra, for taking us through all the 3 case studies. And, with a limited time, you could definitely enlighten the crowd, whatever your thoughts are. Once again, I request all of you to give me a big round of applause. I call upon the 3 group leaders to come forward. They've done a wonderful job of taking you through this 3 case laws. The task was to see that all of you will get confused with the 3 case laws. I hope they have done that.
Confuse the group leader. We are able to confuse the group leader.
No, they were told to confuse the group. Maybe group has confused the group.
We are successful in that.
Yeah. Thank you, sir. So that's what we want. End of the day, everybody will get confused. So if you are more confused, you will just go home and open the book. That's the main idea. Otherwise, if everything is clarified, you will feel that you know everything as such. Yeah, fully confused. Yeah. So let me thank all the 3 group leaders for the wonderful job. I call upon Maithili to come forward and hand over a small memento to Srivalli. No. That's it.
Youngest team was here and it's
Okay.
Thank you very much.
Then I'll call Neha to come forward and give a memento to Vaishaka. I can request Ashutosh to come forward and hand out a small memento to Zain. So members, as you experienced the group discussion, tomorrow morning also we have a same group discussion on case studies on royalty and FTS. We have 3 group leaders who are prepared to take you through that case laws. Either they'll confuse or they'll convince you. That's let us see. So whoever attended the 3 groups, the same menus will be there. Morning 8 o'clock will be the breakfast. I request all the residential and non-residential members to come and have the breakfast. To be served in that restaurant. Next to that pool there is a restaurant where you can have a breakfast. All the residential candidates, so people who are there, there will be a call at 6 o'clock, wake up call. Non-residentials, I cannot give wake up call, but you yourself have to give a wake up call, and maybe for you people 5 o'clock so that you can get ready and come here. Finally, I'll thank Narendra Singh for his wonderful presentation. Call upon the senior member with 42 years of experience, Chettiyappan, to come forward and hand over a memento to Narendra Singh. Nilesh Gupta is here. Yeah. So not signed that room this thing. No, that room you are not signed. You have to give your thing.
Okay.
Huh? Just. So that's for the day. Tomorrow 8 o'clock we'll meet at breakfast this thing, that cafe, and Sorry, not 8 o'clock. 7 o'clock. 7 o'clock the breakfast will start. So I request all of you to have. Yeah, dinner is ready. Dinner is ready. Please have dinner and go to your respective rooms and take rest. Morning 7 o'clock breakfast and 8 o'clock the sessions.